Okay, so let's start on time. Good evening. My name's Yang Wang. Welcome to today's program. To, that's our investing discussion group. Um, Before we start, let me give a brief introduction of the speaker for today, Kristen Jacks. Kristen Jacks is a financial educator and author of Money in Your 20s. Kristen worked for the Kiplinger's Personal Finance magazine and the Mutual Fund magazine before becoming a writer and a speaker. Her next book, Investing Explained, will be available in October. Kristen is a graduate of Duke University. Today's topic is Quants by Wall Street Journal staff reporter Scott Patterson. Now let me turn the screen to Kristen. Thank you,
Thank you,
Kristen.
Young. Thanks so much. And thank you, as always, to Greenwich Library. They do such a nice job putting together really interesting programming. It's a terrific staff, great lineup, and just very happy to be here. And welcome. And we're going to get started. This is the investing discussion group. We meet once a month online. And the theme, this is our second season. And the theme for this season is the best-selling books that will help you reach your financial goals faster. So if you're just joining us, welcome. I see people are just now kind of logging on, which you must really love investing because it's the first beautiful night of spring in a long time. So good for you. I'm going to give it my all because that you really deserve it. If you're not if you logged on instead of enjoying this night outside, that's really impressive. Okay, so second season of the investing discussion group, we're looking at the best-selling books that help you reach your financial goals faster. And as I had said earlier, these segments live on YouTube. The library has its own YouTube channel, which is very easy to find. You go to YouTube and then you enter Greenwich Library in the search bar, and you'll see kind of this like white, you're looking for like the white and green logo, and then you click on that and it takes you to the Greenwich Library channel. So these programs live there. And we've already done a lot of great programs. The Psychology of Money was very well regarded. The Bond King, A Random Walk Down Wall Street is a classic. So there's lots of good stuff there. Okay, and I just wanted to follow up. As I just said, this program lives on YouTube and people watch it throughout the year. So if we're going to capture some people who saw, some of the previous programming, we were talking about angel investing and the two big groups for angel investing, the Tidal River Fund, which is kind of a female only group, and the Angel Investor Forum, which is kind of Connecticut's largest and kind of most reputable angel investor group. I've gotten to know both of those groups really well. They're fascinating. And if anybody wants to email me because they might be interested in joining those groups, I'm sure they would love to have you if you're an accredited investor. So my email is kjacks@moneyinyour20s.com, but it's just been really fun to get to know kind of that topic of angel investing I didn't know so well. And I didn't realize there were so many angel investing enthusiasts in Connecticut. So if you are one of them, then email me and I can hook you up with the right people. Okay, so today we're doing the Quants. The subtitle is How a New Breed of Math Whizzes Conquered Wall Street and Nearly Destroyed It. Very exciting. And then coming up, we're on April 30th. We had delayed this one. I think this was supposed to be our March session, but we delayed it because of school, I think school break or something. I can't remember exactly what it was. But now we have a lot of people signed up, the price you pay for college. So we're taking it from like the investing angle of like, it's such a big cost. And it's one of the reasons people invest. They invest to save up for college. So Ron Lieber, who's the Your Money columnist for the New York Times, spent years coming up with this book to really help parents understand a rather opaque and confusing system so that they get the best deal possible. And he uncovers merit aid, which is a really fascinating and not well understood kind of opaque area where you can, at a top like at a top school in terms of cost, like a very expensive school, you might get $20,000 off the price tag. And this has nothing to do with need. So Merit Aid is this really interesting system that you want to know about if or you want to know about it for you, for your friends, for your siblings, and anybody who's about to face that horrific college cost should really attend and find out at least some of the secrets that can help you get ahead as you're spending the dollars you invested. And then in May, we're doing exchange traded funds. People sometimes think that exchange traded funds are simply mutual funds that you can trade during the day. And that is not exactly true. It's really important to know the difference. I like to say that, when you go to give your coat, if you hand in your coat and you get like a claim check in return, you no longer actually have your coat. It's different. So like a mutual fund actually owns the underlying investments, right? So to me, that's very comforting. But an ETF doesn't actually own the underlying investments. It has a claim on the underlying investments, and it's really kind of interesting how that works. So you're going to want to know about that. You're going to want to know why liquidity could be a problem. You're going to know the benefits, like the tax benefits. So there's a lot going on with ETFs. They're hugely popular. It's really important to understand them thoroughly. Okay, so that's what's coming up. And just before we get started, I want to say that this webinar is for educational purposes only. It is not intended to provide investment advice. None of the investments or investing philosophies mentioned in this discussion group are specifically discouraged or recommended. Did somebody have a question? I heard something in the background. Okay, because it's great if you have questions. Just unmute, say, excuse me. Young, is that you? Do you have a question? Okay.
No, it's not me. I think it is the meeting. Anyone can unmute themselves and, ask question anytime.
Right. But I hear stuff in the background. So should we just maybe mute everybody just in case there's just some chatter? And then, so you can unmute yourself and ask a question, or you can put a question in the chat. Okay, so none of the investments or investing philosophies mentioned in this discussion group are specifically discouraged or recommended. If you plan to invest, you are urged to consult a wide range of professionals, tax expert, lawyer, financial advisor, who are aware of your unique needs and situation. Okay, and like we said, questions, comments, we love participation, so please participate. You can unmute and just say, excuse me, I have a question or a comment or anything. Or you can put a comment or a question in the chat. And I try to stay on top of those. So hopefully I won't, fail to see it. Okay, so who is Scott Patterson, our author here? He's a reporter for the Wall Street Journal. He's written 3 best-selling books. The Quant was his first, then Dark Pools, and then Chaos Kings. He's a winner of the Loeb Award and has a master's degree from a fine university. So very good, reputable guy and excellent writer. Really, really has such a touch, and he made this book so gripping and so interesting and so fun to follow. Okay, but why are we covering it? Why do you care? How can the Quants help you reach your financial goals? Okay, so it really matters how things work. Like it just matters. So a lot of people think they understand how Wall Street works, how investing works, and the Quants have upended a lot of that. So it's really important to know what's going on. It matters how things work, and how things work, how things really work, that has consequences. So you're going to probably be surprised by some of what you hear. It's going to challenge your assumptions. Hopefully, it'll also help you see new opportunities. It might also, based on when the quants get it wrong, make you want to be a little concerned about all the money that flows to hedge funds and quant operations, and especially because those are like pension funds. And, if anything ever blew up, we don't like those too big to fail situations where the government comes in and cleans up a mess that was created by Wall Street people. So you just want to be aware of these dynamics, because I personally would not want to see, the pension funds that are in these hedge funds getting hurt, and then somehow the taxpayer is on the hook because they were dealing with quants and quants didn't know what they were doing. Nothing against quants, but the story the big drama in this story is the quants originally, having this spectacular showing for years and becoming bigger and bigger and more popular. And then there's a total collapse based on their faulty model. So I'll get to that. I don't want to rush ahead, but I think just understanding what's going on in the industry so you can personally keep an eye out, and especially if you are really networked in with your local politicians, like make sure we just don't want the taxpayer ending up with somebody else's mess. And then also, if you're planning for a career change, a new career, whatever, or you're guiding a kid, or you're guiding your nephew or niece or whatever kid down the street, it used to be just go get an MBA, right? Like if you wanted to be in finance, get your MBA. And that has completely changed because of the quants. Now it's get that PhD in math, make sure you understand Python programming, make sure you take data analytics, all these things. It's just so completely changed. Okay, so hopefully that's the value proposition. Okay, so before we dig into the quants, the book in particular, we're saying that it really matters. So it matters how things really work, okay? It matters how things really work. Why am I showing you this picture of a very wet basement? Because, as luck would have it, I have a really good example of why it matters how things really work. So I've lived in my own home for 4 years, and a terrible buzzing alarm went off on a sunny day. And I went down to the basement, and this ear splitting alarm was so awful. And I just turned it off. I just turned it off. And I made a note of it, like, wow, that's this pump alarm, this ear splitting sound, and this pump alarm, and whatever. I just turned it off. Within hours, my basement was completely flooded on a beautiful sunny day. So when, it matters how things really work. And since I had no idea that I needed a continuously running pump system, that's how like life in old Greenwich, Connecticut works. I had a very nasty surprise, very expensive, very unfortunate surprise, because I didn't know how something really worked. I didn't know my basement could flood on a sunny day. So it matters how things really work. And you might think you understand how investing really works. You might think you understand how the markets move and why they move. And it's just supply and demand. And it's just if it's a good investment, it'll eventually go up. And if it's a bad investment, it'll eventually go down. You might think you understand all these things, but the quants have made everything different. So it's important to know. Another thing, it matters how it really works. In 2022, the bond market just got clobbered. It was the worst year for bonds, I think, on record. And a lot of people were stunned. A lot of bondholders were like, wait, I'm in bonds so that I don't lose money. I'm in bonds so that I can sleep at night. I'm in bonds because they're safe. And I had done, I think well before this, I had started to like sound the alarm about how bonds were really a problem. And I had always said that one of the things that bothered me is this myth that bonds are universally safe. And when interest rates got incredibly low, I said, this is just going to end so badly, because people just don't understand that when interest rates rise, bond prices fall. And so if you don't understand how something really works, it matters how things really work. So all these people were just sort of blindly in bonds because they'd always been told you should be 60% in bonds and stocks and 40% in bonds. And then they were holding on to bonds with long, that weren't going to mature for a long time at a very low interest rate. So you could just learn like bond math in half an hour to find out the incredible risk you're taking if you hold bonds that don't mature for a long time and they have a very low interest rate. Like there's like actually mathematical formulas that will just tell you how much your bond price is going to go down if interest rates go up even 1% or 2% or 3%. It's complex math, but like somebody else, a financial advisor, could have done this for you, so you would have understood your risk. So it just matters how things really work. And finally, America's favorite investment, the S&P 500, It matters how it really works. Like people think, oh, I'm so diversified. I've got this wonderful range of companies. I just love Starbucks and Walmart and McDonald's and IBM and Yay and like the S&P 500. Like that's how I get my diversification. That's how I have my hand in all of these companies. And this is what people think they get because they don't understand that it matters how things really work and how a cap weighted system. So most index funds are cap weighted, market cap weighted. In a cap weighted system, the popular stocks get bigger and bigger and bigger. They get purchased more and more and more because that's how the fund is set up to like buy more of the popular stocks and get rid of the less popular stocks. So after a certain amount of time, all of a sudden you have incredible overweighting. So this is what's really going on with the S&P 500. What's really going on is that it's a huge bet on Apple, Microsoft, Google, Tesla, Nvidia, huge bet, huge percentage. The last time I checked, 7 stocks were 28% of all the dollars in an S&P 500 fund. So, if you don't know that, and especially if you don't particularly like to make a big bet on information technology, or you already have a big bet, like maybe you own Apple stock by itself, or maybe you own Microsoft by itself, and you own those by themselves, and you're trying to get diversity through your S&P 500 fund. Well, you're not like you're just piling in more and more. So it matters how things work. So this is something that's really important with the quants. The quants usher in, a lot of they change things, and so you want to know what they're doing, what they're up to. Okay, and if anything I just said surprises you, like the myth that bonds are safe, I think they're safe. They're pretty safe now. You already got crushed. You already got the interest rates, went through the roof. But if the other problems with bonds, because there are a lot of things. I mean, I love bonds. I own bonds, but you have to understand that they really range in terms of credit quality. Nobody knows the direction of interest rates. So if you don't understand like how bonds actually work and what your risks are, you're going to want to find out. So you can, again, these sessions live on YouTube, and you can go to the library's channel on YouTube, and you just go right to it, and you'll see videos, and then you just kind of scroll through them, and you'll see the myth that bonds are safe. And you can find out like there's great things about bonds. I love bonds. I own them, but you can figure out like kind of how to shop for them, and what the real risks are and what the benefits are. And you can also watch, are you really diversified, which really gets to this point of like, if you didn't know that about the S&P 500, just wait. Like you got so many problems. It's really hard. It takes some effort to be diversified. So, so those sessions live on YouTube, and you can watch those. Okay, so if we're saying it matters, it matters how things work. We're going to start with, the history. So where did we get even these theories of how the markets work? And I'm just going to focus on the stock market right now, but certainly the quants, and the quants definitely have a hand in a lot of things. They were in like stock warrants, convertible bonds. They were in different currencies, commodities. I mean, they do all sorts of, they're in all sorts of markets, but not to make it too complicated. We're just going to sort of talk about stocks and then how people, would evaluate an investment, and then you start to see like, well, those are the assumptions that people are making. This is how it works. And then the quants come in and kind of shake everything up and change everything. Okay, so, it's the 1970s, and we've got rotary phones, and we don't even have any linked up computers or email or anything like that. And people go to Wall Street, and there are just certain tools and certain methods, and they've just been with us forever, and they're very familiar. And a lot of people think this is how everything still works. So the first one, and I'm using some language, introducing some language that might be new, but I think it's important, especially if you listen to news or podcasts or things, like you might hear that's like, a bottoms up analysis. And that might sound really confusing. What does that mean? Or a top down analysis. So basically all that means is like the bottoms up analysis, those are the fundamentals, right? Where you start literally with a company. and you look at their financial statements, right? So companies are required by law to disclose how they're doing, disclose their sales, disclose their profit, disclose their debt level, disclose their risk factors, right? So you have those quarterly statements, and they're all registered with the SEC. You can easily find them online. Each individual public business is required to disclose this information, and it's on their balance sheet, income statement, statement of cash flows. Like, so a fundamental analysis, and this is how people think Wall Street usually works, is that like a team of analysts are looking at individual stocks. And certainly this happens, right? You still have analysts that cover an industry or analysts that cover a handful of stocks, and they give ratings like a buy rating or a sell rating or a hold rating. I mean, that stuff happens. And that process is very familiar, but people think that's kind of it. Like that's what goes on Wall Street. And that is definitely not true. So the whole price discovery or how assets are valued, why a stock is a certain price on a certain day, people are putting a lot of weight into the fundamentals. They're assuming it's the fundamentals. They're assuming it's the profit or the growth in the profit or the debt level. And like say, so if it's the debt level and then interest rates rise and the company is going to have to eventually take on more expensive debt, maybe that would be a factor. Okay. So looking at the fundamentals of a company, people are very familiar with that. They think that's kind of how Wall Street works. Okay. So that's one big area, the fundamentals. A whole other area that is equally important is kind of the top down. So the macro, like what's going on in the world. What is the Federal Reserve doing? Where are interest rates going? What are other economic indicators, right? So how is employment going? Marty Zweig was he's passed away, but he wrote this book, Winning on Wall Street, and it's a real gem. And he kind of nailed like all the indicators that you can look at. Sentiment, right? Like how do people feel about the market in general? He looked at all of these sort of macro indicators, and he really actually believed in market timing, which is very discouraged. Like you can't time the market. You will never know when to get in or when to get out. But the pros do these sorts of things. They definitely look at economic indicators. They look at macro. So you've got fundamentals, which is really looking at like a company by company basis of what's going on within that company. And then you have looking at the whole macro environment of interest rates and employment and sentiment and things like that. So, again, this is how people think the system works. Okay. Then you've got the technical people, which I have to mention them. It's supposedly a big part of how Wall Street works. Certainly, if you ever listen to day traders, I mean, they're looking at these charts all the time. And technicals are really just looking at price and volume and how the price moves of any particular asset. Again, I'm sticking with stocks, but Wall Street's up to a bunch of things. I mean, there's, we talked about this, the bonds and the commodities and things like that. But technical analysis is literally just looking at price and volume. And these price movements, there are all sorts of theories and supposed patterns, right? Where if you notice a certain pattern in the price movement, whether it's a support level or a resistance level, like they chart the price of a particular asset over time. And if it keeps bumping up against kind of like the same level and then going no higher, they say, oh, that's a resistance level. Or it keeps falling, but not further than a certain level. Oh, well, that's the support level, right? And then traders and financial people are saying, oh, well, I've noticed this pattern. I'm going to make a bet on the future direction of this asset because I've detected a pattern in the technicals. So, okay, fine. I mean, this is a big part of what Wall Street used to do. And then you have the people who just say, okay, that's all just way too rational, right? Like that very good. You've got your charts and you've got your indicators and you've got your financial statements. But by the way, the market is irrational because it's based on human behavior, and humans overreact, they underreact, they have a herd mentality, they have fear of missing out, they have all these irrational things. And this goes all the way back to Benjamin Graham and the Intelligent Investor, where he invented this guy Mr. Market, who's going to either like purchase a stake in your business or sell you a business, and all these prices are just, they're wild, they just range wildly based on like the mood of Mr. Market, and this theory that Mr. Market is actually manic depressive, and he's too high when he's high and he's too low when he's low. So that's like the whole behavioral side. And so you have, experts on Wall Street that are looking at that as well, and they're saying, and you've got Nobel Prize winners that came along and kind of scoffed at the efficient market hypothesis and scoffed at all the financial people that said, it's not that rational, it's not based on fundamentals, it's not based on macro. And a lot of people just agree the technical is just nonsense. That's just like a random walk. That's people are being fooled by randomness into seeing patterns. But now then these Nobel laureates come along and they're like, well, no, the market's not efficient, but also it's kind of predictively irrational with this, overreacting and underreacting and herd mentality and recency bias and action bias and sort of all these things where you might be able to predict the direction of an asset based on how the bias, people's bias has a pattern. Anyway, so this is what we had, right? Like this is, and in my book that actually came out recently, where I try to write for the non-professional or the non, like, certainly the person who's very unfamiliar with investing. So it's almost like investing for English majors. But in my book, I covered all of this. So like, why did that stock price move? Was it the fundamentals? Was it the macro? Was it the technicals? Was it behavior? And then there are a bunch of things that are just random one-off events like tax loss harvesting, right? So at the end of the year, people might sell a stock that's already gone down quite a bit, because if they take a loss, then that loss can offset a gain they have elsewhere. And they're just doing that for tax purposes, right? Now, if any of this was unfamiliar to you or you're curious about it, I'm happy to send you that particular chapter for free so you can kind of cover all of the things that are known. And I also have algorithmic trading in there, which is what the quants are doing. So there's a lot that could go on, right? Even like a company has a cyber attack and their stock price, tanks. So my email is kjax@moneyinyour20s.com. And if you'd like that free chapter, I'll just email it to you. It would just be a PDF. But it's covering all the things that we're talking about. And so this is, what most investors think goes on. Again, if you have questions, comments, you can unmute or just put it in the chat. All right, so now the quants come along, right? So this is our history of, these are the assumptions that we have about why, in this case, stocks, but certainly any asset of any type is priced a certain way. And then the quants come along, and they come along, it's kind of like this stealth invasion, right? So you've got Wall Street hiring MBAs, or actually even just right out of undergraduate, hiring people to do analytical work, to pore over financial statements, to look at debt levels, things like that. You've got other, economists maybe being leaned on to like help us forecast where things are going, what's going to go on with interest rates, what's going to go on with employment, all those things. And that seems to be how Wall Street's working. You have the technical guys and all that stuff. Then the quants come along, and all of a sudden, everything changes, and it's kind of cool. So what quants do is they collect an enormous amount of data, and this is only possible, right? So a big part of the story is just the rise of the computer and computing power, right? And the fact that computing power became less and less expensive and more powerful. So you have these quants that are data driven, and they collect enormous amounts of data, and they analyze the data, and they're looking for statistical patterns and non-random events and all of these things. And it's just because it's like this geek fest And that's very reminiscent to me of something that's more well known, the Moneyball. I don't know if, or I guess it's called just Moneyball. I don't know if you've ever seen that movie. It's a baseball movie, and it's about the Oakland A's, and they don't have a lot of money. And the guy who comes in to manage the team, he's not just going to go on gut instinct. He's not just going to do things the way they've always been done. He's realizing that you can use data to kind of challenge your bias or assumptions of like what makes a good baseball player, or what things are correlated, or what you know and I'm not a sports fan, but this Moneyball was sort of a great example of like how you could actually transform a team using data and pick different players based on what the data is telling you, not just kind of watching someone pitch and think like, wow, they're good at pitching. In any case, that's kind of the closest that I can get to what was going on with Wall Street and the quants, the whole money ball, like using the probabilities, the data, the computing power, and really no gut instinct. Like that just goes out. Nobody cares about gut instinct. Okay, so what are some of the highlights of the story? So really the quant starts with this revolution of the computer and the math geek and people. So you've got these kind of geeky guys, right? So here are our key players. Now Cliff Asneth actually is very famous in Greenwich because AQR is actually in Greenwich, and he was a University of Chicago PhD, and he studied with Gene Fama, who's the like legendary economist who discovered the or yeah discovered, or what do you say if you, I guess you say his is the efficient market theory. Um, in any case, so Cliff Asness, genius, uh, comes on the scene, and he's kind of looking at how the markets are working, but he could just see, like, it's just, he's starting to see that like there's a different way to do things, that you can notice patterns in the data. So at University of Chicago, they had access to this database. I think it's called CRISP. Can't remember what it stands for, where they were kind of looking at the outcomes for all different sorts of investments. And they just had, a ton of historic data, and they finally had the computing power to really delve into it. And instead of finding that, markets are basically efficient, there are obvious patterns that can't be ignored, really. So Cliff Asness writes his PhD thesis on momentum. And we're going to talk about momentum later because that's one of the opportunities, since all the quants are kind of obsessed with momentum. But it's this idea that, like, if you take a stock price, that if the stock has been going down, it has this downward momentum, it will just continue to go down. And if a stock is going up and has this upward momentum, it will continue to go up. Now, I'm sure I'm not privy to other specific things they're looking at, or how long it needs to be going up, or how long it needs to be going down, or what the volume has to be. So that's kind of like their quant secret. But they all talk about momentum being a pattern that they've discovered just by analyzing tons and tons and tons of data, because they have access to it, and because they have the computing power, and because they're math whizzes and they can study statistics and probabilities and things like that. And they just isolate this thing that's momentum. And so once they have it isolated, they're like, we can go out in the world and find, we can program a computer to look for those things. And when it's found, it's like, buy, or sell, depending on which way the momentum is going. And you could actually program a computer with an algorithm to just capture that. And all of a sudden, you're just making money. And it has nothing to do with, well, I guess it's kind of technical. I mean, I say it's like, it has nothing to do with any of the old history of how Wall Street works, but it is a price indicator. So maybe you would put it under like the technical camp, but it's kind of like technicals on steroids, considering how much you're going to buy, and how the algorithm is just going to do it without any input. It's kind of fascinating. So You have Cliff Asness coming out of U Chicago. He gets scooped up by Goldman Sachs. Goldman Sachs gives him money to get his whole quantitative group going. And they're noticing many, many things, right? A lot of them, they notice a lot of things that have to do with value, right? So things that are assets that are kind of cheap versus assets that are relatively expensive. He starts noticing all these patterns, which you would say, oh, well, that's just fundamentals, right? We're back to the fundamentals. You look at like, PE ratios and profit and, what does the asset cost? But somehow he's doing it on this massive scale and looking at other countries. And he's literally like shorting things in other, stocks in other countries that are overpriced and writing these computer programs where it's like, go out into these other countries and for the stocks that are cheap, buy them, and for the stocks that are expensive, short them. And it's all pre-programmed. It's just kind of fascinating. So it's noticing these patterns, creating algorithms, programming the computers, letting the computers run, not getting in the way. That's really what the story of the quants is. So you have Cliff Asness doing that. You have Jim Simons at Renaissance Technologies, kind of coming out of nowhere, and he was a math, and certainly a math genius. Ran the math department at Stony Brook, and he just realizes that he can see these patterns that markets are not efficient, right? They're mostly efficient. They're very efficient, but not 100%. And he has the ability to look at data and to hire the people who can look at data. So what's so interesting about Jim Simons, and so this is what the whole book is about, right? You're going to get to know these characters. They are not getting MBAs, right? They're not studying financial statements. They're not doing all the stuff that we think of as normal. Instead, Jim Simons, who is a math PhD, runs the math department at Stony Brook. He's noticing all of these things, and he's like, I'm going to put this team together. I'm going to hire code breakers, right? I'm going to hire, he has these theories about like who can help me find these patterns, who can help me, sift through this data. And once you start getting into code breakers and physicists, PhDs and things like that, you realize you have completely left the normal methods of Wall Street, and you're just doing something else. You're taking big data from the past. You're finding correlations, you're finding patterns, and then you're testing those to see if they would work in the future before you actually, throw any money at it. You're testing those to see if they actually work. And it's really just fascinating to read this book. And so all of these guys, and it's all guys, that's what they're all doing. They're all sort of capturing this idea that you can use your sort of math genius or just basic pattern genius, right? Like I'm sure a code breaker is just a pattern genius, right? Use your brain power, use the computer power to find these patterns, to test these patterns, and then manage risk with these patterns. And it's the risk management where everything blows up. And that's kind of the fun part. But, because you think you've got these geniuses and they're putting together these algorithms and there's just this part of the book where it's like they're making $1 million a day, but they're not doing anything. They just told the computer to do it. And the computer just makes $1 million profit a day just running the data that, just these algorithms that they've created. It's really, really fascinating. So, okay, so Cliff Asness, University of Chicago, genius, goes to Goldman, then starts his own thing. Jim Simons, I mean, I can't remember his actual credentials, but he ends up a total genius, top schools. Then he goes and he's the head of the math department at Stony Brook, figures out that he wants a shot at the big time, puts together an amazing team. I think Renaissance Technologies, his company, is considered the most successful hedge fund ever for years and years and years and years. Nobody can get into it. It's completely closed, but it's just kind of really cool to read about and some of the things, the theories that he comes up with. Extremely secretive, extremely secretive. So you find out more from the other guys, kind of what they were up to. Jim Simons does not reveal much. And then, okay, so then you have Boaz Weinstein at Deutsche Bank, and when he was at Deutsche Bank, he's not there any longer. He was the co-head of global credit. So he's getting into all these things that you might recognize from when the subprime mortgage stuff imploded, but like credit default swaps and collateral debt obligations and all these things that were sort of mortgage related, or I guess they were related to a lot of different debt instruments. But anyway, these guys are kind of finding all these things to trade and finding mispricings and finding patterns. And the same thing with Peter Mueller, who, so PDT, I can't remember what it's, proprietary data, something or other. So he's running a unit, a quant unit within Morgan Stanley. Ken Griffin is a genius who, just from I think when he was at Harvard, like people kind of noticed his genius. He was trading out of his dorm room. He gets backers almost immediately and takes very little money and he's like printing money with his computer know-how, with his quant abilities. And Citadel now, I mean, Citadel is huge. I've had so many people tell me in Greenwich that they very briefly worked at Citadel. So, it became this behemoth, or it still is this behemoth. But this is what's going on with all of these quants. And then what makes the story interesting, I mean, it's just an interesting story anyway, because all these things are coming up, the way Wall Street normally works has just completely changed. And these guys are all becoming outrageously wealthy. And the money is just pouring in. And, these like a Goldman Sachs or a Morgan Stanley, they sort of tested these theories at first. They gave them a little bit of money. And then the results are so staggering that it's like, Goldman Sachs like, here's $4 billion, have at it. Jim Simons is so wildly successful that people are just begging him to take their money. And he finally is like, no, like I have more money than I know what to do with. And a lot of these guys would say that, if you have to put too much money to work, it's like you can't find enough patterns or opportunities or whatever, and you can mess up your own trade if you put too much money into it. So all of these guys become wildly successful, money is thrown at them, and then some bad things happen. And this is another fascinating part of the story, because you can imagine, like in a fundamental land, right, in the old way of doing things, where you're just like looking at statements or technicals or macro or whatever. It's like, well, the macro, the unexpected macro thing might be, I don't know, the Fed refuses to raise interest rates. I mean, this is what everybody's talking about now. So it's like, okay, well, that's going to impact the market, but it's not going to make the market necessarily implode. But what the really interesting thing that happens in this book is the implosion, because what we have are math people and people who are trying to use their math skills to find patterns and make predictions, right? And so it's really important that when they're doing that, that they're making certain assumptions. And this is now going to seem like way too mathy or, whatever, but it's a big part of what went on with the quants, where when you're looking at probabilities, or when you're looking at like any phenomenon, right? Like if you're just looking at like, what's the normal distribution? What's the normal range of height, right? Just take the normal range of height, like the typical adult, right? So you're going to have a bell curve, right? You're going to have like, most people are going to fall. If you're talking about women, they're going to fall between like 5'1" and 5'6", and then it gets really, the tail ends. It's like, you can have some really short women that are 4'8". You can have some really tall women that are 6'2", but and then it kind of goes off from there. Like there are very, very almost no 7 feet women, and there are almost no like 3 feet women. So that's a normal distribution, right? Everyone's like accustomed to like a normal distribution, or even a distribution of grades, right? Especially with all the grade inflation, everything's just kind of getting crowded around like, the A-B range or whatever. Maybe that's not such a normal distribution, but these guys, when they're programming their computers, when they're making their bets, they are adding to their bets certain probabilities, right? Because if they're just going to like press a button and let a computer run, must have some like if then statements or something, when things start to go awry, when something out in the world starts to seem a little too risky, what are they adding into these algorithms? And what you find out in this book is that they are saying that the movement of stock prices, I'm just going to keep saying stock prices, but keep in mind, these guys were in everything. They were in the commodities, they were in the bonds, they were in all sorts of things. But let's just, for simplicity, let's just pretend that, and they're heavy into stocks, but let's just pretend that's all they're doing. So whatever programs they're writing, whatever patterns they're seeing, they're also realizing that, it's still like markets are volatile and markets are wild and, all different things can happen. So they have to have some safeguards. They have to have some risk management. But all of their risk management is based on what they consider a normal, probable distribution of outcomes, of events, of whatever, right? And what gets discovered is that that's not actually how markets work, that there's something called a fat tail, right? So when you look at a normal distribution, a normal bell curve, and you look far to the left and far to the right, on a normal distribution, it looks like that flat lines out to zero. But in a fat tail distribution, on the far left and the far right, you have some pretty wacky things kind of bubbling up that, there's some action going on there. There's some data going on there. There's some inputs going on there that you better like all, if you're talking about the height of women, all of a sudden you have a 9-foot woman. Like, okay, no, that doesn't happen, right? Like we think of like there's a normal distribution, but in the markets, you can have some really wild things happen. And that's what these quants originally were not prepared for. So their models don't work when really unusual things start happening, especially bad things. So there's in this, you have all these guys and they're making a ton of money. I mean, they are the kings. Cliff Asness is at Goldman Sachs and it's just been a slam dunk of success. So he can go out on his own and he can start his own hedge fund and he gets $1 billion backing. So he goes out, he has 2 partners. I can't remember the names of his partners. He's on TV and stuff. He's always giving his partners credit. But for whatever reason, in this particular story, they don't really focus on the partners. They just focus on Cliff Asness. And it's incredible to get $1 billion backing when you leave Goldman Sachs to open your first hedge fund. So it's incredible how Citadel grew. So that Ken Griffin, who was like a nobody, comes out of nowhere, gets this financial backing, and then his empire just grows and grows and grows and grows because of all of his quant magic. Same thing with Jim Simon. So for the people like kind of in the know, not like, normal people who just have a 401k and they pick their Vanguard funds, their T. Rowe Price funds or whatever. None of these guys would be like household names. But if you're running a pension fund or if you're running an endowment, like a Yale endowment, you're getting to know these people because they're getting incredible results and they have these institutional clients. And it's the institutional clients. It's not individuals that the individuals are not participating at AQR, right? Cliff Asness did not go knocking on doors trying to get my $10,000 or your $10,000. No, like he and his partners were going, I'm going to say, I don't know if he called on Yale, but like, because Yale's so famous for its endowment, but like a Yale or a Harvard or any of these enormous endowments, they always look for the next big thing. And they're always in communication with these hedge funds. And so these guys become hugely popular. They're backed so well. And then their system breaks down. So in August 2007, something goes very, very wrong. And in a matter of days, these guys that have been like the kings, right? So Cliff Asmus at AQR, he was backed with like $1 billion. But by August 2007, I can't remember the exact numbers, but let's say he's got 20 billion or something. He loses 2 billion in a matter of days. And he's looking at his computer screen and everything's blinking and everything's crashing and the models aren't working. His predictive models of like what should be happening right now, none of that is working. The whole market is just crashing. And why is that? It's very confusing, but it's you have to read the book, but it's not just that it's crashing. It's not just that the market crashed, the stock market crashed. Everything that they expected. So these guys go out and they are long certain stocks, meaning they've purchased stocks and they're holding on to them. And they are short other stocks, which means they've made a bet that these stocks are going down. So the bets that they have made, the exact opposite is happening. And then there's this contagion of things, certain assets doing poorly that nobody can explain. Like, why is there this contagion? So they have this theory that one of the big asset managers must have gotten in trouble somehow. And all of these guys are very leveraged, right? So leverage meaning, I mean, on a personal level, like we understand like margin accounts, right? So if I want to make a bet, I can amplify my bet by borrowing money from my broker. So if I'm allowed to, if I'm cleared to, I could have a margin account. So I can add leverage to my bet, right? But if things go the wrong direction, I'm going to get a margin call. I'm going to be asked to put in more of my own money because I borrowed money and now my bet's going the wrong way and blah, blah, blah. So all of these guys, because their plans had been foolproof up to this point and they were always winning, they were using a lot of margin. And it's kind of shocking. So apparently some of these guys were like 8-1, like every dollar of their own dollar, they were borrowing like $8. So you can imagine that if your bet starts to go bad and whoever loaned you the money is going to want you to like sell off some assets to get their money back, that then you're going to have to go into like a selling frenzy, right? So if you've levered up 8-1, and then you have one of these fat tail unexpected situations where your bets go really south and you're levered up 8-1, you are in some serious, serious trouble. So that's the theory, is that somewhere in August 2007, in the quant world, all of these guys that have these, actually, I want to look at one thing. So we've got the fat tails, we've got what are called the crowded trades. So a lot of these quants were overlapping each other. They were coming up with the same patterns. They were seeing the same opportunities. And then they were piling into the kind of the same bets. So that was a whole other part. So you have like not anticipating the fat tails. So their predictive models did not really cover the true risk, even though these guys were geniuses and this is what they were supposed to be able to do. Then they had the crowded trades because they're noticing the same patterns, they're making the same bets. Then they have this enormous amount of leverage and they are really in trouble when their bets start to go wrong. And then there's this contagion from the unwinding, because when their bets start to go wrong, they just have to sell whatever they have, right? So they don't, say they were they own a portfolio of bonds, they own a portfolio of stocks, they own a portfolio of commodities. When you just have to start selling things to make good on the money that you borrowed, that's this contagion. And they call it unwinding because you're kind of like unwinding all these bets that you made so that you can pay off your debts. And then, so this starts to creep into whole other parts of the market that nobody was expecting, because they weren't expecting anyone to have to like do a fire sale. So all of a sudden, all different asset prices are starting to fall. And so a lot of bets are going south that nobody could have predicted. Okay, so here we are, all of these guys at this part in the book, they're all in serious trouble. No one got out unscathed. Nobody looked smarter than anybody else. Actually, that's not true. Maybe Ken Griffin looked pretty smart. Ken Griffin yeah, if I could give money to Citadel, I probably would. But in any case, the whole story of the quants is kind of like understanding how so much on Wall Street has changed, so much of the way that the bets that are made, what's a, it's not just like, wow, like Starbucks, what a great company, what a great product. Just love that coffee. Fantastic management team. And do we think their market share is going to grow? It just has nothing to do with that. It's just huge data analytics, computers, algorithms, big bets based on past behavior, risk management that failed. But it's just so fascinating. And by the way, this is still going on. I mean, so you have this implosion, you have this huge problem in 2007. And then it gets even worse when you get to the financial crisis, obviously. So the book is really interesting. All these guys kind of teeter on, well, especially AQR was just pummeled. Citadel, not as bad, but it still goes on today. I mean, so all these guys, did they learn their lesson? Sure. And did they come out the other end? Sure. But you have to understand that this is all still happening. And that's when we get to the modern day, because of two things, passive investing and quants. You have people like David Einhorn of Greenlight Capital, he's just such a respected classic value investor. And he's old school. It's like, go out there, look at the companies that have like a great story to tell, but their fundamentals, because you look at their fundamentals, you can tell that they are undervalued, and you can tell that they have a really solid trajectory, that the market isn't really seeing the story, isn't understanding what's possible for these individual companies. So you have somebody like David Einhorn. I think he says he goes into maybe 15 companies. That's all he's looking at, is to make bets on like 15 companies. And he's saying, because of passive investing, so that's like the money flowing into index funds rather than actively managed money. And because of the quants, his view is that the markets are fundamentally broken. Like everything we know about like how assets get priced is fundamentally broken, because you either have passive investing, where all the money flows into index funds, it just keeps doing what it's been doing into the S&P 500, or you have these quants that are messing up the price discovery because they're just looking at old patterns and creating trades based on old patterns. And so price discovery, classic price discovery, has really been lost. And he says that, like, he would go out there and he would find like a great value story, a company with a, great product, great leadership, gaining market share, terrific prospects, blah, 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 very well run. And it, for whatever reason, would have like, it's some great intrinsic value, but a low price. And he would buy it. And in the old world, that would, over the course of a few years, that would turn into a great investment, that like the price would go up or the multiple or whatever. If things worked the way they were supposed to, that company would be rewarded with a higher stock price. And he's saying that just stopped happening because passive and quants have really changed how assets get priced. And he claims that the market is fundamentally broken. Now, okay, but is that like terrible news? I don't know. So hopefully, we understand why it matters how things really work. This has challenged your assumptions. David Einhorn is saying, the price discovery is broken, the markets don't work. That sounds pretty scary, right? But you can also see it as like that there are some new opportunities out there. If you really understand that passive has taken over and the quants have taken over, well, what might that mean? And it's like, well, you got to tune into quant speak and the quant world, and what are quants doing, and where's their activity? And so, for example, we're going to get back to momentum. We were talking about momentum. And I'm just taking this from a quant guy, Eduardo Repetto. So I think he actually was he a nuclear physicist? And again, you find out about these guys. They all have PhDs and none of them have MBAs. But he says momentum is fascinating. Momentum is something that we observe, but we don't understand why it happens. A security that has extremely bad performance will continue to have, for some short period of time, bad performance. And a security that has extremely good performance will continue to have, for some short period of time, good performance, right? All the quants talk about this. It's always on their radar. So, it's kind of a new opportunity, right? So if you know that this is the way quants see the world and this is how they're kind of programming their computers, that if you see a stock that has momentum, maybe you could ride that wave. Certainly, you should probably try to avoid a stock that, like, if it's been going down for a while, unless you're dying to own it. I mean, if all the quants think that something that's on a downward trajectory is going to continue on that trajectory, then maybe it's a bad idea. Like maybe you shouldn't get in. They're pressuring the market to keep it going down. Or since they all feel that way, I mean, I've done this personally, that the stuff that's going down is going to continue to go down. If you start looking at short positions, and you can just Google this, you can just say, like, what are the most shorted stocks out there? You'll see, probably see some names you recognize, like, for example, Beyond Meat, right? BYND, I think is the ticker symbol. Heavily, heavily shorted stock. Well, in the quant world, if it's very shorted and it's got this downward momentum where it's just been going down, 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 that's a stock I look out for because of a short squeeze, right? So I like to keep an eye on that stock. And if it ever starts to move up again, I jump on it because that could be a short squeeze when a stock is really, really shorted and all the quants, are against it because of their views of momentum. Then, if you see it turn, if you see it move, and something could turn into a short squeeze, that stock could just skyrocket up. So that happened with Beyond Meat. And, I think it went from like $7 to $11 in 2 days for no reason. It's not that the stock was any more worthy or less worthy or anything like that. It's just that, once you have all those shorts piling in and all these quants saying that, we don't go touch that stuff because that stock has been going down, it's going to continue to go down. That creates like perfect short squeeze opportunities. So I think if you read the book, The Quants, if you start to like learn how quants, sort of the big ideas that quants tend to embrace, then you might find patterns or opportunities. Certainly never bet against the quants, because they're a powerhouse. But maybe, and also if you see like unusual price action in anything that you own, you might just know, oh, well, I don't know what the algorithm is. I don't, I don't know who's doing that, but you don't have to panic. If you personally know there's nothing wrong with the asset, then you don't have to panic. You just know that some quants are doing something funky with their algorithms. And I think there's some security in that because certainly in this book, they cover like big, big price swings that had nothing to do with the merits, the underlying merits of the asset. And it was all like the algorithms and the quants kind of doing their thing. So there you have it. There's an opportunity. Again, questions, comments, just unmute or put in the chat. But I do want to also talk about, since the quants have kind of taken over and this is where the institutions, so you have like nonprofits and endowments and pension funds, all these big funds like that they go into the hedge funds and they look for, ways that, beyond just regular investing, they're looking for opportunities. And so they're turning to the quants looking for alpha, right? So looking to beat the market. What worries me, and why I just think it's important to kind of keep track of like what's really happening on Wall Street is if that's what these quants are doing and they make like an error, right? Or they cause anything to really get misaligned and say a pension fund loses a lot of money, it worries me that that could end up on our shoulders, right? Because pensions are guaranteed retirements. They're promised to people. And so what if like our government has to bail out a pension fund? Like that's a little scary. So I just think it's important to keep an eye on how Wall Street works and where institutional money is flowing. I mean, I'm sure if a college endowment got slammed, that would just be kind of too bad for them. But I, just keep an eye on it, right? So I'm a little concerned about that. I hope noticing the implosion that occurred in 2007 that was all quant driven, um, could happen again. Now it was quant driven, and then we had the financial crisis, and quants had a hand in all of that too. So, but then everything got better. We built our way back. But if there's a big implosion again, I don't like to keep track of where the money is and who needs to get bailed out and whether or not it's getting bailed out fairly and who's paying for it. Okay, and then the final thing is just if you think you know how the world works, like right now I have a college student and she was going to be an econ major. And I said, no, you're not going to be an econ major. You're going to be a math major, which was fine with her. She loves math. She's great at math. But it hadn't really occurred to her, like, well, why would I be a math major? And I'm like, well, if you want to go into asset management, you're probably going to need you're just going to be more valuable as a math PhD than an MBA, right? But it depends, right? So, not to knock MBAs, if you want to run a company, it's great to have an MBA. If you want to go into investment banking, so you want to be reaching out to companies for mergers and acquisitions, or you want to help companies issue a bond, or you want to help companies, issue stock, right? That investment banking, I mean, that's still MBA driven. But if you actually want to manage assets, right? Um, they're hiring quants. So they want people who, for my own daughter, I was like, I want you to take data classes. I want you to take Python coding. I want you to take math classes. That's the talent pool that they're looking for. They're not looking for the typical MBA. So things have really changed. I mean, it's just so interesting to me that this quant revolution and what the future looks like. So there you have it. Now, like we said, coming up, the price you pay for college on April 30th and exchange traded funds on May 14th. And this particular webinar will live on the YouTube channel for the library. And I'm going to check the chat, but I don't think we have any questions.
There's no question, no comments. Kristen, would you ask the people whether their opinion about topics or books to read for next session, next series?
Oh, right. Yes. So we are planning for the next year, next season. So starting next September for the investing discussion group. And there's so many great topics, right? You could just do bonds, just do economic indicators. You could just do cryptocurrency. So anything that people are interested in. Young, do you want to put your email in the chat?
Yes, I'm going to do it now.
Yeah, so Young Wong runs this on the library side, and you can email her or you can email me. Hold on, let me switch. I think okay, here's my email. But we're always looking for people to give their input. What topics do they want us to cover? I mean, there's so many great topics. There's alternative investments, there's private credit. So you just let us know and we'd love to accommodate. And for anybody who is watching this video, I'll probably just read. I don't know if you click the chat, I don't know if it shows up in the video, but Young Wong is YWANG at greenwichlibrary.org. And I'm kjax at moneyinyour20s.com. And we would love to hear from you. And that is
if
it.
we still have some time, if no more question about today's topic, do you want to just mention about the topics we are discussing to see what the people's opinion about that? if they have questions or things to talk about on today's topic, please continue. If not, we still have some time.
Oh, so you mean like go over some of the topics that we're looking for
Yeah,
next year?
see if yeah, to get some ideas to see if they think this is a good topic with books. Next year we're going to talk about not just the book, but expand on the topic itself and give more. You're going to have like a lecture on the topic and then talk about a book to
Sure. I mean,
see.
I think what I'll do is I'm gonna just exit. How do I exit out of this? There we go. I
Share screen.
I will. Let's do this. Ba, 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 ba. So what were we were looking at various things. There are all sorts of, so again, it might be anchored to a book. We're thinking about that. So the Wall Street Journal has a guide to the 50 economic indicators that really matter. That looked good. The power of zero. This is a really interesting topic about tax savings. So as people near retirement, there are books that are written about strategies to keep your taxes really, really low and what kind of vehicles do you need to be I mean these are like Roth conversions and all these things, but I mean I think it's this the power of zero is saying how to get to the 0% tax bracket and transform your retirement. That's a little bit of overselling. It's really hard to get to zero, but I read, I think I read the first three chapters, and it's like it's kind of compelling to be thinking about it now, like as you're putting money away in different tax shelters. He has some really good advice about kind of where it's all going and what to definitely do as you approach retirement. There's always cryptocurrencies, right? There's always the psychology of investing. So Robert Cialdini wrote The Psychology of Persuasion, and that's been used in investing. I have to delve more into it, but like The Psychology of Money, Misbehaving, there are all these books that are sort of on the psychology side. What did we have?
Kristen,
Real estate.
sorry to
Yeah.
interrupt you. There's a very interesting suggestion in the chat box.
Oh, let's take a look.
See if you can find some the sample of the testing thing. We can do
Oh,
it the next time. We can have like 10 questions or 10
oh,
questions
that would
on
be
each
really
topic
good.
for each session. That's a very good suggestion.
Oh, I really like that. Yeah, test your knowledge. That's really good. I
Yeah, we
always do
can.
those when I find them online.
Yeah, we can have on this subject. We can find some testing question for each session. That's a very good idea. And we can create a poll on the Zoom, and they can answer yes or no, and then you can see how they do in the
Oh, that'd be
testing.
fun.
Yeah,
Do
yeah. Zoom has the you can do a poll, answer the question.
I
Yeah,
like that
we can do
idea.
that.
That's
Yeah.
great. So okay, so we've got that. We have alternative investments, taxes, bonds, real estate. Yeah, anything, that those are all the things that I just have in my notes that we're looking at. Okay. Anything else? All right. Well, I think that kind of covers it.
Yeah, if they have questions, they can unmute themselves and they can talk.
Yeah. If anybody has a question now, if you want to unmute, otherwise I think we'll wrap it up.
Okay, go ahead.
Oh, see something in the chat. Best way to evaluate stocks. That is a good one. Yes. Yes. How to evaluate a stock. I think that's a really, really good one.
Use our value line database.
But
Right?
then they've done the work for you. But yeah, we're going to get into the library has amazing resources. They just have like incredible resources. I go in all the time and I use their S&P database to look at bond ratings, right? So if I'm looking at a stock, I actually, if that company has issued stock, I go in and I look at their bond ratings because that's a great way to figure out. I mean, that's what these bond rating agencies do, is they really evaluate the prospects for the company. So if they're going to give a very high bond rating, that means they have a very favorable opinion of the company. So yeah, that's great. I want to write this down in my notes, the best way to evaluate a stock.
Kristen,
Yeah.
I forgot. I have a news to share with everyone here.
Yeah.
If you like to read Wall Street Journal, if you have Greenwich Library card, you can have remote access now. I can share the screen. So if you, after you finish wrapping up today's topic, I can show, the group how to access the remote access to Wall Street Journal from our
Yeah.
website.
Why don't you go ahead?
Okay, so I need to share screen. So I'm going to stop your screen and share mine.
Yeah, go ahead. That's great.
Okay. I think starting from last week. Okay, wait a second. Where is my screen?
Is that not your screen? It's not mine.
It's my screen now.
Are you using a different computer?
No, I just need to go to my screen. Can you see my screen, Kristen? Can you see
Yes.
my screen? Okay. Okay, this is greenwichlibrary.org. Go to Explore under Digital Library. Scroll down for e-newspaper. You will see e-newspaper. We have New York Times, we have Wall Street Journal, but under Wall Street Journal, you see there are two links. One is access the paper from the library. The other one is remote access Wall Street Journal. So if you're from home, you click on this link. It's a little bit slow, the internet.
Do you know if
See now, they ask you to enter your library card number and your PIN. Then you can access.
is there a limit to how many people can use it at one time?
Uh, no, I think we have reasonable. I have no problem. We have this service starting from last week. I have no problem to access from my cell phone.
Because I don't know why anyone would continue to pay for the Wall Street Journal if all
Yeah.
they have to do is use your
Yes.
website.
Yes. Yes.
Unless they thought
See?
they were going to be like locked out because you know it can only be 10
If
people
you
at
have
a time.
Greenwich Library card, see, I'm accessing now. So all you need to do is sign in. After you have the library card, you're signing with your name and the email, and then create a password, then you're fine. You can access from your phone. One account, you can have 6 different devices to access using the same account. That's to say, if you create an account, you can share with your husband, with your 2 children. They can use their own cell phone, iPad, computer, access to that.
That's amazing because that's
It
an
is.
expensive subscription.
It is. So, my colleague dropped the subscription right away. Last week, after we got the news from our resource management department, we created account right away, and my colleague just dropped her subscription to the newspaper right there.
Yeah, because it's expensive.
It
I mean,
is.
I
Yeah.
subscribe.
You
So
don't
as
have to
long as
pay
I'm not
next
going to get
month.
like,
You
it's
don't
going to
have to
say,
pay next month.
yeah, but like as long as it's not going to say, well, there are too many people, doing it at
No,
one time.
no, we have enough. I don't know exactly how many people can use at the same time, but I never heard any complaint.
Yeah, that's great.
Yes. Yeah, that's all I have to share.
Well, I think we are
Okay,
done. Unless anybody has another question, want to say anything?
not me.
Well, thanks everybody. Thank
Then,
you for joining us. Hope to see you
hope
next
to
time.
next time is April 30th. How to pay for your college. Okay, thank you, Kristen. Thank you everyone for coming today. Thank you
Thank you,
and
Young.
goodbye.
Bye.
Oh, by the way, we're gonna launch this video on our YouTube channel, probably later this week or next week.
Sounds great.
Okay. Okay. Good night, everyone. Bye bye.